All right. I know everyone's got their earbuds away right now, right? Ain't no one got the earbuds in. Ain't no one still got that, right? Everyone's paying attention to me right about meow. Okay, because this is going to be a lot of me talking today, and it's a little bit of work. So I need 100% attention because there's not really much math to go along with this. Today we're actually going to talk about investing. So a lot of it's vocabulary, a lot of it is actually where we get these information from. So when depositing money into a bank, you are making a cash investment. Okay? Going from your pocket into the bank, it is a cash investment. The account's interest rate guarantees a certain percent increase on your investment. It's called a return. So when it goes into a bank, that is a low risk investment, but it's also low return. So it's at the small percentages, like maybe a 1% or less return on your money, as long as your money sits in that account for a long period of time. So that's called your return. Other kinds of investments are riskier, called stocks and bonds. These are similar to what we have for these investments, but you're investing in something different. Stocks. Investors purchase stocks, shares of ownership in a company. For example, if a company has issued a total of 1 million shares, and an investor owns 20,000 of these shares, the investor owns their amount divided by a million, 2%. Okay? 2% right there. And it's called a shareholder. Those people are referred to as a shareholder. Now, if you own just one stock, you're still a shareholder. So that means you own part of a company. This already written on. Anyway, buying or selling stocks is referred to as trading. Stocks are traded on an exchange. There's two different exchanges that was big here in the U.S., which is the NASDAQ, which is a tech-based thing, and then the Dow Jones is the other one with just about everyone on there. So those are my two types of stock exchanges. There are two ways to make money by investing in stocks. You sell shares for more money than you paid for them, in which that you have a capital gain on the sale of that stock. So, you guys remember a couple years ago that whole GameStop thing where people were buying shares of that and selling it, right? Okay, so the big deal about that was it started out at $4 a share. People bought it at $4 a share. Then the market, because so many people were buying it, it went up to over $600 a share. So if you bought one stock for $4 and you sell it for $600, your capital gain would be $5.96. You would have a capital gain of $5.96 for every share of the stock. For every share of that stock that you own, you're going to get that amount. But capital gains, that's a high interest on capital gains. They tax almost 40% of capital gains. While you own the stock, the company distributes all or part of its profits to shareholders as dividends. For some of you people in here, I'm hoping you will start some type of investment coming up here soon, because you have time to invest in stuff. You know what? Instead of actually buying that new video game, what is it, like $80 now or something? So take $80, go and invest in something. Go to Dow Jones, go to what's it, Charles Schwab, or there's like all kinds of different companies you can go with. So open up an account, be like, hey, I want to trade stocks. Buy some stocks. Take your money, put it in there. You own part of that. So when you do that, look for stocks that have dividends. That means when a stock makes profit, they share their profit. I'll give you an example. I own stocks in a company, okay, and let's say I own 100 shares. If I own 100 shares of that company and their dividends, they come out to be $1 per share. That means I take that $1 per share, I just now got an extra $100, right? And what I do with that is I just roll it back in. I just buy more of the company. I don't take that money out, I buy more of the company. So the next year, when they share their profits, that I no longer own 100, I probably own like 105. And so the next year, when there is dividends, hopefully I will get more money off of that too. And if it is a productive company, that means that company is actually making profit every year, then it's not just the dividend, it's also the price of the company is going up. So if I bought it at $20 and now it's valued at $25, for every piece of stock that I bought, I could sell each one for $25 as a $5 profit off each one that I sell. So that's what this is. And I'm hoping some people actually will get into this, because this is an easy way to make money without having to work hourly. You want to work for yourself? Try investing. But you have to put a lot of time, effort, and research into what you're buying. In order to raise money and dilute the ownership of current stockholders, companies sell bonds. People who buy bonds are lending money to the company from which that they buy the bond. So a bond is basically, they're asking you to be the bank. If you go to a bank, you borrow money, okay, you get that money, but then they charge you interest, right? You pay it back with interest. A bond is the same thing, but you're the bank. You are going to give them $1,000. They will pay you back plus interest. But it's in smaller amounts. Okay, it's like $1,000 bond or $2,000 bond, or you're not going to a big bank where the big bank actually sells them and then they pay the bank back. They're paying you back. That's what the bond is for. Now, okay, so bonds are a commitment from a company to pay the price an investor pays for the bond at the time it was purchased. It's called a face value, along with interest payments at given rates. So basically, if I buy a $1,000 bond, they give me a certain percentage. I might, after 5 years, I might get, $1,100. Might have made an extra $100 off of it, depending on what the rate that they guaranteed that they're going to pay. A listing of all the investments a person holds is called a financial portfolio. Most financial advisors recommend a portfolio with mixture of low risk and high risk investment called diversified. That first thing that we talked about was a savings account. Savings account is very low risk. It is a low interest. You'll get a little bit of money off of it. Not very much, maybe like 1% interest. It won't be very high, but it is a low risk. Where if you're buying stocks, those are higher risk. Because the company, yes, the company looks good right now. Maybe tomorrow something happens and the company goes out of business. That's a higher risk. Okay? And so, reading stocks. So, daily newspaper, online services give current stock prices and other information about stocks. The company name is shown at the top of the chart. Under this, the stock exchange is given. To the right of the stock exchange is the trading symbol. Right here, trading symbol. Name of company. We got Apple. On the stock exchange is NASDAQ. You'll see NASDAQ or Dow Jones. Okay, closing price would be here. So the closing price on this current day, right here. So market closed at that. Next thing, right here, we're going to have that. With this, the opening price. So it opened right here. That means that's how much I started with. On this day, it opened here. During the same day, it went up to 145.65. The low of the day, the lowest price that it was trading for was 142.65. And the change right here is from the previous day, it went up 1.87 points or 1.31%. So when you actually do this in the calculator or on the computer for your MyLab, you're going to have to do these things right here, okay? It's going to ask you this stuff. Next thing is, second row, the 52-week high refers to the highest price at which the Apple's stocks traded. Past 52 weeks, the highest price was $145.65 per share. Means that during the past 52 weeks, at least one investor was willing to pay $145.65 for a share of Apple stock. The third row with the 52-week low refers to the lowest price Apple stock trading during the past 52 weeks. Now, why does it always use 52 weeks? What is 52 weeks? 1 year. 52 weeks is 1 year. Okay? 52 weeks is 1 year. So that's why it says it like that. So over the past year, that's what the lowest price was. Now we are going to financial column of the chart. Volume refers to the number of shares traded on that day in millions. Thus, 99 million was traded on that day. The second row, average volume, refers to average shares traded in the day over millions over a fixed period. The average volume is provided for comparison purposes. Since the volume of shares traded on that day was this, okay, see the trading at Apple stock that was heavier than normal on that day. So this was on the day. This is the average. So it's more than average. It's going to ask you, is it above average or below average? So if that was average, this was above average. Market cap refers to the total value of a company's shares of stock, given millions in trillions of dollars. Thus, the total value of Apple stock was $2.4 trillion on July 9th. Because why? Everyone's got to have those crappy iPhones. Everyone's got to buy those those AirPods, okay, where you lose them like twice a day, okay, and every year your phone breaks, right? Your Apple phone got to get a new one. Suckers. And for this last one, PE ratio stands for the price to earnings ratio. Closing price per share, annual earnings per share. This will make more sense here in a moment. So we're going to use this here. We're going to use this one here. So it's nice and big, so you guys can see it here. Okay? It's on your page, but we're going to go through and we're going to fill out all these things. And you are going to help me with this. I don't know why all my notes are already filled in. Okay, use a stock table for Amazon to answer the following questions. Okay, you guys have the stock table there. You're not trying to do homework right now because that would just piss me off because this is a whole lot of stuff you have to know right now. If you're not paying attention, you know what? Poo on you. Booyah! Pay attention. Okay, what was the closing price of a share Amazon stock on July 9th? What is it? There we go. So it's 3,719.34. Is that pretty easy?
Yeah.
Yes, you're just reading through this stuff. What was the closing price up or down for the previous day?
Down.
It's down. Hey, look, it's right there. Red arrow, it's down. Okay, by how much?
12.7.
And it is 12.07 points or 0.32%. So on your homework, it's actually going to ask you for both. It's going to have you the points and the percent. So what was the closing price on the previous trading day? Now, this is one that's going to get you. It's going to get you. So we're going to take this number right here. We do 3719.34, and then we're going to subtract our down amount. No, this one's going to be add because it's down. 12.07. Because it's down for the previous day, I need to add. If it was up from the previous day, I would subtract. So please do the math for me, please.
3,731.41.
3,007.
31.41.
31.41?
Yeah.
Okay. That's all you got to do. Easy, right?
Yeah.
So it's almost like you might want to write that in your notes because you're going to ask me about it later on. And I'm going to say, hey, why don't you write this down in your notes? Your pencil's down on the floor. You can't write it since your pencil's on the floor. Ah. What's wrong? Go back?
Writing.
Oh, now you're writing it down. Uh-huh.
I be writing.
You've been writing.
Yes.
I'd be good at math. Okay, so gotta move on. I'll come back to it in a minute if you need it, okay?
I'm not.
Okay, good. What were the highs and lows for Amazon on July 9th? What was the high?
3,000.
374. Yeah, 4800, right? And then the low, 3593.4, right? 0.40. There you go. Okay, what is the highs and lows for the past 52 weeks? 52-week high, it's right over there. 375999. Next one is going to be the low, which would be 00. There we go. All right. How many shares of Amazon were traded on July 9th? How many were traded on that day? Yeah, 3.75 million. Was this above or below the average? Above, because it looks, there's the average right below that, and it's more than the average. So this is above average. Ah. What was the total value of Amazon stock on that day? That's what the market cap means.
$1.88 trillion.
Okay, 1.88 trillion. Alrighty. So, next one. It says compute Amazon annual earnings per share using this right here. So, the math is actually pretty easy. I left it on here so you know where it comes from. Closing price per share, which is right here. We got this number right here, closing price, divided by the PE, which is right here. So as you're reading this, it's just going to be like that. You're taking these two numbers, divide them, and that's going to be your annual earnings per share. So that's probably going to be the most complicated part of the math here. Alrighty, so now, next part right here, this is just talking about the different investments, so I know you're paying attention. Okay, you can use regular savings and investment accounts to save for retirement. There is also a variety of accounts designed specifically for retirement savings. A traditional individual retirement account, IRA, is a saving plan that allows you to set aside money for retirement up to $6,000 per year for people under 50, $7,000 per year for people 50 or older. You do not pay taxes on the money you deposit into the IRA. You can start withdrawing with your IRA when you're 59 and a half. The withdrawals are taxed. So think of it like this. You don't pay tax on it now, but in the future, when you are getting your retirement check, instead of having your $1,000 that you should be getting, government's got to take their bite out of it, right? So you're only going to receive like $700 of what you were supposed to have, because they're going to tax it afterwards, after you already made the money. Okay? This next one is a Roth IRA, it's important right here. Roth IRA is slightly different tax benefits. You pay taxes on the money you deposit into the IRA. So you pay taxes now, but you can withdraw your earnings tax-free when you're 59 and a half years old. Although your contributions are not tax deductible, your earnings are never taxed, even after withdrawal. So it's better to pay tax on it now, let your money grow, and then you don't have to worry about the taxes on any of it later. I am not a fiduciary agent. I cannot give you financial advice, but that sounds pretty good to me. Anyway, employer-sponsored retirement plans include 401ks, 403b plans set up by an employer who often makes contribution to the plans on your behalf. These plans are not offered by all employers and are used to attract high-quality employees. Now, serious question. Who actually has a job right now? That's not like just cash on the table. Okay, Kermit, where do you work? Postinos? Oh, Postinos. Okay, so do you know if they actually offer that? The 401k?
Yeah.
They do? Yes?
Oh, the retirement?
Do they offer it?
Oh, no.
You can go to the website. Sometimes if you go to the website, the company website, you can see that they do offer it. You just have to ask for it. And then they can put money towards a retirement plan for you. Where do you work? Sky Zone. That might be similar. I don't know about that one though. Yeah, I know management there does have it though. Okay, anyone else got a real job? Where are you working? Shoe Palace. Okay. Maybe they have it, but that's not like a big chain, is it? Yeah, so I don't know if they will have it, but you have to look at the company and company information. They actually talk about what they do offer. So if it's on the company webpage, then they will offer it. Then, you know what, they might actually put money aside for you. So currently, my employer, this school district, I put away money, and they double what it is. So if I put away $500 towards my retirement, they also add another $500 towards my retirement. So that's important. So it's actually free money each time. Each time they you put money away, they match it. Okay, so an example, I will pay $500, okay? $500 goes toward my own retirement. The school matches that. So they will actually come out with an extra $500 into that. So after just one paycheck of that $500, guess what? I just made an extra $500, didn't I? That's matching. That's important. Okay, that's money I didn't have to actually make, but because I put money away, they matched what I put away. That sound good? Yeah. So when you're looking at companies and places to work, okay, some people have to be a real adult here soon. That's something you should look into. Will they match your 401k? And guess what? There we go. That's it. We're going to like, share, and subscribe. Hit that notification button. And you people are going to finish up the homework right about meow.